The opinions expressed on Two-Way Traffic are those of Darren Coleman and are for general information purposes only. It does not constitute any legally binding engagement between the podcasters and anyone else. Always check with your advisors to obtain your own tax or investment advice. Welcome to Two-Way Traffic with Darren Coleman of Portage Cross-Border Wealth Management. In this series, Darren aims to guide you through the complexities, complications, implications, and most importantly, the advantages of having money and family on both sides of the border. In this episode, tax lawyer Shlomi Levy and tax accountant Kevyn Nightingale join Darren to discuss the impact of the ongoing John Tavares CRA dispute.
Hi, everyone. My name is Darren Coleman, and welcome back to another edition of Two-Way Traffic, the cross-border podcast. And today I'm delighted to be joined by two of my good friends, Kevyn Nightingale and Shlomi Levy of Levy Salas. And this is a really interesting partnership that you guys have created together. Kevyn is, I would imagine, especially amongst his peers, is an accountant and probably one of the top cross-border tax accountants in North America, which would make him one of the top Canada-US tax partners in the world, and Shlomi. Oh, come on, I'm teasing Shlomi. And Shlomi Steve Levy, who's one of the top cross-border tax attorneys in North America, and therefore one of the top cross-border tax attorneys in the world for Canada-US taxation. So, gentlemen, thank you both for joining me. I'm really appreciative of your time, and really appreciative of you bringing your skills and expertise and profile to this conversation today.
Thanks for having us.
Delighted as usual, Darren.
Okay, terrific. So you guys, so before we get into what we're going to talk about, the Tavares case. So this is John Tavares and his tax issues with CRA. We're going to talk a bit about that. But before we get into that, I think we should just mention that you guys, it's only been you're in your fourth month now of joining forces together. Kevyn bringing a substantial expertise and capability on tax accountancy and that side of it, and to Steve, your practice as a tax attorney. Do you want to talk a little bit about why you guys decided to join forces?
Well, I mean, it's something that kind of was called for in the industry. Kevyn and I have led, and he's a little bit more experienced than I am, but we've
older.
Led,
is that what you're going to say?
No, just experience. But we've led.
Just so the listeners know, we are friends, so I will take some good friend shots at you guys.
Indeed. We've led parallel careers. You know, him in the compliance and tax planning, and I'm on the legal and tax planning. And we've led parallel careers for the greater part of the last 20 years. And when Kevyn decided to share with me his thoughts about, the next chapter in his professional career, we thought this would be a great opportunity for us to service clients on a one-stop shop basis, giving them both angles and both perspectives. I think that so far, so great. I mean, the community, the overall tax community has welcomed this idea with open arms, and we're being tasked with new mandates practically on a daily basis, and we're able to bring our expertise onto one file at the same time. And it could be overwhelming for the common denominator client, but once you get to the higher level experts, it's a breath of fresh air. So we're very thrilled to have Kevyn. Our team here is very well versed, so he's able to just come in and pretty much hit the ground running with files and clients and advice. So it's been terrific, and we're very, very thrilled. Now, maybe Kevyn has a different side, but we'll let him say.
No, I think overall it's been terrific. I come from a long history of working with accounting firms. The last one I was at a very large accounting firm for 15 years, great accounting firm. And I do have a law degree as well. And I thought it would be time to explore what that would be like working in a law firm.
I didn't really know you also had a law degree. Holy cow.
Yeah.
Wow.
Got my LLM in 2018, just to round out, because I didn't have enough letters after my name.
Just as a hobby. Okay. Well, look,
But
I think you guys are very well known in the cross-border tax and legal communities. You really are at the top of your games, and it's remarkable how much horsepower now you would bring to your clients, being able to cover so much ground at such a high level. And your client base is a lot of, we would have, I'll call them creatives. You have a lot of athletes, hockey players, a lot of executives, professors. You guys really have got a high-end client base who have that unique complexity of having lives that are cascading across the Canada-US border and even further, right? Is that a fair summary?
I think that is, and that. But I would say, although we do have all of those things, probably the core of our business is business people who have more run-of-the-mill kinds of businesses that do things and sell things and make things.
Yeah.
And many of them, if you're doing business in Canada at any scale, you're doing business cross-border. And
Right.
if you are a client of a certain sort, it's very likely you've got a kid who's gone to the United States and may have decided to stay there.
Mm-hmm.
So there's a whole lot of ways that people can end up with cross-border issues. Someone 20 years ago may have gone down to the United States, met someone, come back here with that person, got married, and lo and behold, not just the spouse is a U.S. citizen, but their kids are also U.S. citizens. All that leads to cross-border tax issues.
Yeah, and there's a lot of tangliness. My friend from Newfoundland calls it, if it's complicated, he says it's tangly.
Oh, that's a great word.
Yeah, it's a wonderful word for this. So we're
I'm
going
going to steal that one.
Oh, you owe me a quarter, and then I got to pay him, so it's all good. But if I can convince you guys to come back on this another time, we'll dig into some of those other complexities. For today, I thought we'd go after one that's interesting because it's got a lot of headlines around it. And I think, Kevin, you're right. For most of us, the clients we deal with that have the bulk of these problems, I would call them the millionaire next door types that run just quiet businesses you don't think about, but you need them. But this one with John Tavares is a big headline one. It's getting a lot of press and attention. And I'll just kind of summarize for people that haven't been following it, or if you have, I'll just give you the short story here. So John Tavares, captain of the Toronto Maple Leafs, hometown boy. It was a big deal back in July of 2018 when he went into free agency and signed with the Toronto Maple Leafs and came and he would talk about, I remember some interviews where he said he used to have Toronto Maple Leaf bed sheets when he was a kid. So real big deal for him to come and play for his home team. Back in 2018, he signed a 7-year contract that would have paid him $77 million, and $15 million of that was an upfront signing bonus. And then 6 years later, CRA comes knocking and wants millions of dollars of unpaid taxes because of the way the deal was structured. So I think that's an interesting thing. And it certainly put a scare on, I think, a lot of sports fans saying, if this is this extra taxation, it's hard enough for Canadian teams to win. We're going to start making some Toronto Maple Leafs jokes, I'm sure, as we go through this. So it has an impact on how teams can recruit. It has an impact on players, but not just in hockey. This could apply to every sports team, I think, but also in the corporate world, trying to bring talent to Canada, whether you can play ball or shoot a puck or not. So let's just dig into this a little bit. So maybe I'll ask Kevin to go first because it starts maybe as a tax thing. And I know you guys have players. You do not represent Mr. Tavares. We should make that disclaimer up front. But you do work with other hockey players and athletes and other people that would have a similar problem. So we're not going to talk about any specific clients. But from your perspective, maybe Kevin, I'll start with you. What are some of the major issues that this case or this situation just starts to showcase?
Well, the meta issue is it's expensive to get athletes to come to Canada.
Yeah.
The tax difference between Canada and the United States is wide and has been widening over years, especially since 2015 with the then new Canadian Liberal government that decided to raise tax rates, particularly on high earners. And they were thinking of your garden variety, homegrown high earners. But if in a world where talent is mobile, particularly in things like sport, if you raise tax rates, you lower their effective income. What they care about is the after-tax income that they get. And so someone comparing, coming to play for the Toronto Maple Leafs, where tax rates are 53.5% on the vast majority of their income, and going to Florida, where the tax rate is 37%, that makes a big difference.
Yeah.
Now, there are other states where there are significant taxes. So California is getting close, and New York City is getting close. But there are ways of dealing with that in the United States that still make the tax rate effectively lower for many, many players. That's just a rate question, but it's been hard and it's been getting harder over the past 8 years.
So the structuring of like Mr. Tavares' contract, for example, was trying to give him some tax benefit by structuring a signing bonus versus a salary. Maybe Shlomi, can you dig into why that mattered and maybe it won't matter?
Yeah. So, professional athletes these days are trying to protect themselves from all kinds of elements, including injuries. Teams are also creating projections for cash flow and understanding that money might be more available or less available in the coming years. And so there's more and more signing bonuses in the National Hockey League. It's a very, very common practice in the NFL for the reason being that contracts are not guaranteed. So a wide receiver that signs for 250 million is probably taking 100 million up front, because if he's having a bad training camp or a big injury, the team could release him and be released out of that contract. So signing bonuses in different sports have a different purpose. In the NHL, we started seeing these signing bonuses around 2016, 17. So John's contract might have been one of the first ones with these types of upfront signing bonuses. And the reason being is that by paying him more, these guys, and adding some clauses into their contracts like non-movements and non-trade clauses, their contracts become extremely difficult to buy out because the money is already paid up front. So who's going to want to take all this risk buying somebody out where he's been paid all this money, but the cap hit remains the same? And what happens with these long contracts is John received 15 million up front. His last year of contract, although his cap hit is, in the 7 million, but he's going to be only receiving a few $1,000,000 in this year playing hockey. So he's received the money up front. From a strategy of signing bonus and the timing of all the signatures and the way things shaped up, with hindsight, you may want to question the strategy because of the CRA involvement. You're looking at the tax rates. You're looking at the fact that the tax paid in the state of New York isn't credited against the Canadian side based on the Canada-US tax treaty. All these things and the risk, there's a risk management, right? And I remember reading that the potential tax savings were probably 1.3 million. But now if CRA gets his way, between penalties, interest, 6 years down the road, it would be probably 3 or 4 times that amount in payment. So you got to question the strategy. And I think that one of the things that I like to discuss with clients and athletes, the same, is what's the risk, appetite? What's the risk? And then what is the reward versus the risk? And then you want to go and make sure people take those calculated risks if one was there. Obviously, I don't like to do anything aggressive, but I understand as advisors, I understand why they did everything they did. But with hindsight, with all this headache and trouble, and God knows how long this may take to settle, it might just not been worth it. And I represent, I don't know, north of 50 NHL players. Come training camp, these guys can't be bothered with legal discussions, tax discussions, or anything.
They're kind of focused.
They play hockey and they want to be focused. They've got their hands full with the season, especially if you're playing in big markets like Toronto or Montreal, New York, and then with their family commitments and all that stuff. They can't be bothered. This is going to be a huge distraction for John and his family if this doesn't get settled quickly.
If I can maybe I can back up and add a little bit of background to the nuts and bolts of this.
Yeah.
So for people who are not familiar with the tax dispute itself, what's going on is when Tavares was paid the signing bonus, what CRA doesn't like is that instead of paying full Canadian tax of 53.5% on the signing bonus, because John Tavares was not a resident of Canada, he only had to pay Canadian tax of 15% on the signing bonus portion that he received prior to coming to Canada. So,
and actually, just to refine that, I think his assumption was he was not a resident of Canada. And I think that's what CRA is challenging, right? Does actually
no. CRA does not appear to be arguing whether he's a resident or not.
Okay,
so I don't think that's an issue here.
Okay.
So he was, by all counts, a non-resident of Canada because he was living in New York and playing for the Islanders. And he had not yet come to Canada when he got this portion of the signing bonus. Now, he ultimately did move to Canada, but that was after the fact. So we're only talking about the part that he received prior to coming to Canada.
Okay.
And the deal is, if you have a signing bonus and it's properly characterized as a signing bonus, and you're a non-resident of Canada and it's paid by a Canadian team, your Canadian tax goes down from 53.5% to 15%. So that is a sizable savings. There's a but. The but is he's a resident of the United States. As a resident of the United States, he has to pay U.S. tax on his worldwide income.
Right.
And he's paying U.S. tax and he's paying New York State tax because he lives in New York State. Now, he will get a credit for the Canadian 15%, but he's still paying effective U.S. and New York rates that may go as high as 45% or even more, something higher than that. So Shlomi was right. Savings about $1 million.
Yeah, between the difference of the New York tax rate and what the Canadian tax rate would have been. Okay.
That's right. So yes, he would have been ahead of the game, but not by a huge amount. It's not like someone who's living in Texas or living in Florida.
Okay.
Which many athletes do for exactly that reason, by the way.
Right.
So, but CRA says we don't care what the U.S. aspect is. We lost the difference between 53 and 15. That's what we care about.
Yes.
So we want more tax. So I thought it would be useful to put the nuts and bolts in front of your audience to say, here's what we're arguing about. CRA cares about that difference, which is, almost 40 points.
Wow. Okay. That's a big hit. And is part of it, as you mentioned earlier, it's the characterization of a signing bonus. Is that also part of what CRA is saying, is that it wasn't a signing bonus, so you received it as income once you move back to Canada? Is that where their argument hinges?
CRA is arguing what constitutes a signing bonus.
Okay.
And if it's really in a substantive way employment income, but you call it a signing bonus, we're still going to call it employment income. And employment income, just fully taxable.
Right.
Now, the difference between those two is not always clear. So one of the factors that goes into it is whether the employee, in this case the athlete, has to repay any of it if he doesn't actually show up to work. So injured, retired, not feeling like working, that kind of stuff. Well, apparently that is not an issue here. So that is an issue with some signing bonuses. That's not an issue here because if Tavares did not show, he would not get the signing bonus. Okay. Sorry, whether he showed or not, he got the signing bonus. I apologize, I got it backwards.
Right. That's okay.
Whether he showed or not, he gets the signing bonus. It's his.
Yeah.
So that argument is a loser for CRA because they just don't have the facts on their side. They've used it in other circumstances.
Yeah, the nature of the NHL contract is you signed a contract that's guaranteed, you're owed the money. In case of injury, if Kevin mentioned the question of injury, in case of injury, the player's performance payments come from insurance, so it's covered. But that $15 million by contract would fit the definition of bonus based on the NHL type contract. So
then where do you think CRA has their ground to stand on in this one?
Well, CRA is waving their hands. CRA is saying it's just so big compared to everything else. Signing bonus in total is almost $71 million. They're just saying, well, that can't not be employment income. That has to, that just has to be. It's so big compared to everything else. 71 million of the 77 million, it just has to be, employment income. That's it.
So in their words, like you've so designed this, it's not possible. Like you took an inch and you went 2 miles, so it's too far.
So there's an old saying, pigs get fat and hogs get slaughtered, and they're trying to use that argument.
Got it. Now, Okay, so I won't ask you to adjudicate this, but has this put, like Steve, you got to, or Shlomi, because, I call you both, you've got to negotiate contracts. Now, how does this affect how you negotiate or how you talk to players about this? Or even executives that have, I would imagine, a similar compensation strategy. The numbers may not be the same, but does it change how you plan?
Well, right now, until there's a judgment on this, it definitely puts people on their back feet. Like their heroes are dug, and people are waiting to see how this is going to be played out. And I want to say this: only the first 15 million of the signing bonus is being contested here, because the following bonuses were paid to him as a Canadian citizen and tax resident. So it's not really contested. The bulk of the work I've done is mostly with Canadian athletes who are resident here. So we haven't had any of these issues. We do deal with a lot of Canadian athletes who married American girls. So the complexity is still there. But I would say that a lot of free agents, especially when it comes to baseball and even the CFL in Toronto, are going to be looking at this carefully and deciding how to.
Yeah, because as a group, they have more Americans moving to Canada than hockey players, right?
Correct. And the competition, although right now even Americans and Europeans. I mean, you look at Toronto, you've got Austin Matthews, who's an American citizen, therefore U.S., right? And he'll probably straddle that line, so he's never considered a Canadian tax resident for outside the income he earns in the season. You've got some Europeans with Nylander in Toronto as well, big contract, big signing bonuses. So a lot of people are going to be watching this, and the strategy for Canadian teams might change significantly depending on what this judgment produces as a consequence.
Yeah, and then I think fans are watching this saying, like, the tax thing can really affect the fortunes of how teams are going to be able to produce. Because if they've got such a huge tax hurdle, their salary caps don't really deal with that too much. So how are we ever going to recruit top talent if this is an issue?
Well, and I'd add on to that, uncertainty all by itself is an impediment to hiring people, to doing business in anywhere. If you don't know what the answer is going to be, a lot of businesses just go, I'm sorry, I'm hands off until you guys resolve this.
Yeah, the juice isn't worth the squeeze. I got other options.
Canadians are, and look, and we're fighting, opposite kind of tax systems, right? In the U.S., your individual tax rates at the federal level are low, and if you're lucky enough to play in a state like Florida or Texas, where there is no state tax, as Kevin mentioned earlier, your maximum tax exposure is 37%. Now we'll assume these guys are all making over $1 million, so 37% versus 53.5%. Do the math, right? There was some issues here a few years ago in a Canadian team, I won't mention which, where a player was negotiating as a free agent, unrestricted free agent, and ended up signing the same numerical deal, but one season less with Dallas versus the Canadian team, and everybody went up in uproars. And look, the argument is very simple. He was going to make net the same amount of money playing 1 year less. So either giving him a chance to beat his body less, or if he were to be successful, deal with another unrestricted free agency market 1 year prior at a younger age. So agents, players are a lot more sophisticated. There's a lot more that goes into negotiations than just the numerical value. 100 million in Montreal or Toronto is easily 85 in the US, and add to that life, weather, taxes, and probably playing less for the same amount of net money. And at the end of the day, these athletes are phenomenal athletes. They're phenomenal individuals. They're well-tuned machines, but they also have an expiration date on their career, and they're trying to maximize it. And for these guys, I happen to not know that player particularly, but he is playing for a coach that I know in Russia right now, and he was able to extend his career by a few years because now he's able to play there, make more money, enjoy the game, and kind of sunset from the game on his own terms, where most of our Canadian athletes are pretty much grinding it to the day their contract expires, and some of them are physically
it's hard. Yeah, we've got a few retired players too, and it's shockingly hard on their body when they're 20, and all those things they take into their 30s, 40s, 50s, and beyond, and it just gets harder.
Right.
So this is something that many governments have trouble coming to terms with, and that is there are limits to tax. And this is the thin edge of the wedge. where you see at the top end, the talent is mobile. And you can't just say, well, we're going to raise their tax rates from 45 to 55%, and we're going to get 10 extra points. No, people respond. People respond to incentives. And if you tell them you're going to pay that much more here, they'll say, I'll go somewhere else where I can do better on a net basis. And that is not just the NHL and NBA and football and basketball and baseball. It is every sport, but it's also more importantly in business. And business is more and more global, and employment is more and more global at the top end. You see this every time, major Canadian corporations are hiring a CEO. They're not just looking in Canada. Right. They're looking in the States too. Well, if you're a potential CEO coming up from the States, you say, well, I understand your taxes are that much higher. You got to pay me that much more if you want me. Well, that makes the Canadian company that much less competitive.
So you're right, because you run into a problem, which is two things. One is it's hard to recruit from people from the lower tax jurisdiction to come to our higher tax jurisdiction. But then because of the way Canadians are taxed, and I want to get into this a little bit because a lot of people don't know this nuance, it's a lot easier for Canadians to leave our tax system. And so we not only have trouble recruiting brain power, but we also can lose talent and brain power because, and I think a lot of people need to know this. It's surprising to me how many people are surprised by this. And it's the difference between how Americans are taxed, which is on citizenship, and Canadians are taxed on residency. So I'll do jump ball. Who wants to run with that one?
Well, I don't want
Shlomi or Kevin.
And Kevin could say again. I wanted to go back to a statement made a bit earlier.
Okay.
I think that one of the other big concerns we should have as Canadians is the attitude our current government has kind of implemented strategies and their attitude since 2015 of just grabbing as much as they can get. You look at the way the treaty works, and very often there's a bit of IOU, Canada to the US and US to Canada. It all works on an IOU system, foreign tax credits and all. And for years it worked just fine until this current government came and started piling up all kinds of new catches and new grabs to make it so much more difficult. And just recent legislation they've pushed forward about businesses and foreign affiliates doing business and foreign tax credits going up and down, and the imposition or their wish to impose dividends from a foreign affiliate at an extra 22% in Canada, and then one day issue a credit on extractions of dividends from that company. These are cash grabs that are telling people, a guy sitting in his office thinking about expansion to the US and thinking that he's going to use corporate money and get taxed like an individual, and the foreign tax and the compliance and the this and the that. Next thing you know, he's like, forget it, I'm not going to do it. I'm just not going to do it. And it takes away from our ability to expand our business ideas into the US. And what it does, and this is a segue to what Kevin's going to speak to you about, what it does really is it pushes American businesses into our society. Because they're coming in here, they're landing at 30, 35, sometimes 40% discount on operating. And they've got a brand new market. And, we have no answer for them because our Canadian government just wants to tax the bejitters out of us.
So the Canadian enterprise is being heavily disadvantaged against their American competitor, doesn't have to deal with some of these complexities.
That's right.
So let's go back to the residency versus citizenship thing for a second, because this is where I get worried, because we deal with a lot of executives, for example, that have the ability to remove themselves from Canadian taxation. So Kevin, do you want to handle how that basic nature of taxation works?
Sure. And I think it's very timely because as a result of the things we've been talking about, Shlomi and I have been seeing a huge uptick in the number of wealthy people who are looking to leave Canada.
I was going to ask you
They're
this.
People who've sold their businesses, or people who have successful businesses, and they say, you know what, I'm sick and tired of paying Canadian tax rates. I want to, they just want to have a number of reasons. They say, I'm going to move to the United States. And that is now a big piece of our business. This comes and goes in waves. Right now, we're seeing a wave of Canadians wanting to move to the United States. Mm-hmm. What Canada does is Canada taxes residents on their worldwide income. If you live in Canada, and I'll talk about what that means in a second, then everything you earn as an individual, and sometimes stuff even that other entities earn, you have to pay tax on. If you're a non-resident, you only pay tax on the income that is earned in that jurisdiction. So, well, I'll try the simple way to begin with. If I'm a Canadian and I have a rental property in Florida, I pay US tax on the rental income I make on that rental property in Florida, but I don't pay US tax on anything else.
Okay.
In Canada, I pay tax on everything I earn here, including on the rental property income from Florida. And then I get a foreign tax credit for what I pay, so I don't get double taxed.
I had the complexity of filing my tax return, but I don't pay any extra tax.
You don't pay extra tax generally.
Right.
It can happen, but mostly you don't pay extra tax. So the idea is when you're not resident, you pay tax on the income from a source in that country, but not on everything. When you're resident, you pay tax on everything. So if you're a resident of Canada, basically, and you're a well-to-do individual, you're looking at a tax rate of 53.5%
Right.
on
Pretty much everything.
It's
Right.
not true in every province. So Alberta has lower tax rates, but it's true for the vast majority of Canadians. So
Right.
BC, Ontario, Quebec are all there. Maritime provinces are higher, some of them. So, Alberta's the outlier.
And I don't know if you guys noticed this, but a few years ago when the tax rate was getting close to 50, it was like 48, 49, that was high. But it seemed like as soon as it crossed the 50%, that became a really emotional threshold for people to say, hang on a minute, the government's getting more than I'm getting. Like when it was 50-50, maybe that was a reasonable deal. But as soon as you went over that seems immoral.
People stopped feeling as though it was acceptable. And remember, that's before you pay HST and luxury tax.
Well, yeah, that's on what you get, not on what you're paying. Yeah, you have that. Remember that part too, right? So as a Canadian, you can exit Canada, whereas Americans are taxed on citizenship. Unless they go through a process of renouncing their citizenship, they're stuck paying no matter where they go. But Canadians, if they choose to leave, they can go through a process and they can now stop paying Canadian taxes. So what does the leaving part look like?
So residency in Canada is a facts and circumstances question, which is a fancy lawyerish way of saying, what does it look like, feel like, and smell like? And then, or if it walks like a duck and quacks like a duck, it's a resident. So if you want to move, you basically have to actually move how you live. So if you're married and you have kids, then your spouse and your kids have to go with you. Your minor kids, not your grown-up kids.
Right.
They have to go with you. If you have a home in more than one place, then you have to spend substantially all of your time in that other place. You have to really make it look like you live somewhere. You can't just do it for appearances. And that's what moving to Canada mostly looks like. Now, there is a Canada-US treaty that has more specific rules for people who have, sort of on the edge kinds of questions. That's probably more detailed than we need to get into here.
Sure.
But when people say, I want to move, sometimes they come to me and they say, well, I have a home in both places and I have kids and, I still want to keep my kids at school here, but I want to spend lots of time down there. And then it gets dicey and, every case is, sort of its own unique little being.
But the basic rule is you just have to, like, but you move. And so if you go through the process and you move, you stop paying, right?
Yeah.
That's it.
You got to pack up and leave.
Now there's a cost to getting out.
Well, it's not free. So that's the part we should also do. There is a one more time they get you, right?
Yeah. Why don't you talk about the deemed disposition, Shlomi?
Yeah. Well, so, the Canadian government basically can tax you in 3 occasions: when you sell something, when you die, or when you depart.
It's not when you breathe? I thought it was when you breathe. Just to move slightly, they get you. But okay.
It's coming up. It's coming up to a tax office near you. And basically, in order to pack up and leave, Canada will deem that you have sold all your assets at fair market value. And so here comes the extensive and interesting calculation of what is it going to cost you to pack up and leave and to move to Florida or Arizona or California. And that's where it becomes tricky, right? A lot of people, especially on the wealthier side, there's complex structures, there's complex planning that's in place, often not thinking about a potential move, but some of the newer generation is already integrating these types of ideas into their plans so that in the event of, and typically, somebody who is going to pick up and leave will be looking at, take an example where they have $20 million worth of assets and 10 of it is pure capital gains. In terms of packing up and leaving, they'll need to write the Canadian government a check for almost $3.5 million today with the new inclusion rates. So it's a lot of money.
Although, interestingly, on that new inclusion rate thing, what's interesting to me is that when the government recently changed the capital gains rate, we saw a lot, and they did it purposely to get people to trigger capital gains earlier than maybe they did. So I bet you for a lot of people, they just went through this exercise and they just made the deemed disposition, or they sold the asset. So their going away part now is maybe a little cheaper.
Well, if they were planning on going away, that's one thing. But there are a lot of people who didn't know if or when they would be going. And you wouldn't want to prepay tax if you're not planning on otherwise paying the tax, again, on Shlomi's 3 different options for another 6 or 8 years. And then you say, well, I've changed my mind now. Well, it's a bit too late now.
Right.
No, that's fair. But I know people, especially in their portfolios where it's just about selling a stock or a security, it was pretty easy to hit a button. And some people said, you know what, let me clear out some of my embedded capital gains if I'm at risk of them being over the threshold if I own it personally. Let me just do this now at the lower tax rate. Now I bet some of them are looking at their books going, actually, this may not be as costly as it would have been. I already paid the tax, so maybe I go. So the door might be a little easier to walk through. But this is a problem, isn't it? That now as Canadians, if people can go through the process, and I imagine work with smart folks like you to help minimize, because there's got to be some strategies, right, to be able to minimize that deemed disposition hit if you have proper planning. Is that a reasonable comment?
It's a reasonable comment. There's ways to minimize, provided that your fact pattern aligns and your strategies align. There's also a way to defer. The Canadian government does give you an opportunity to seek permission to defer by posting bond and guaranteeing at least the value of the, by way of a letter of credit, the cost of maintaining a letter of credit. But at the end of the day, it's a question of determination. How determined is the person to leave? I've dealt recently with a gentleman who went through the exercise, realized how much money it was going to cost him, but also realized how much money he was going to save over, let's say, the next 10-year period, and then did the math. And when you're, again, the same example, you're going to spend $3.5 million on departure tax, but your overall tax savings on your assets over the next 10 years will amount to, let's say, $7 or $8 million. Well, guess what? You're leaving your kids an extra $4.5 million while enjoying a different lifestyle, not getting aggravated with this tax system. And most of the time, that particular client went to Florida, so the weather and all the other stuff.
Not shoveling the snow in the winter.
Correct. So
it's an attraction.
There's a lot of reasons why people pick up and leave. There's a lot of the wealthier they are, the easier it is to kind of run numbers and show a cost effectiveness. Besides the aggravation and the weather, there's a cost effectiveness to moving. So it's
well, sorry to interrupt, but it's not just. I think what's also interesting to me is the number of jurisdictions globally that are competing for that type of person, where it's not just the delta between the Canadian tax rate and Ontario to Florida. Maybe it's Ontario to Bahamas where it's 0, or Dubai or other places. So if you have that flexibility, and I would argue with after the pandemic, a huge number of people work just as we are. They work remotely. If they've got a laptop and a camera, they can work. So this remote worker thing, and as I say, we're seeing countries that have had remote worker visas and other things to attract you to those jurisdictions, and their tax rates are vastly lower than even the United States, right?
They are. There's one thing you got to warn people about here.
Yeah.
Money is a tool that allows you to live the way you want to live.
Right.
And the place you live has a huge impact on how you live. Mm-hmm. And so if you choose Dubai because you'll save the most amount of tax by going to Dubai, but you hate Dubai, then you become a prisoner of your money.
Fair enough.
So you're not making your money work for you.
Right.
So most of our clients are choosing places that are more like home than far away. So we're seeing people go to familiar places like Florida and Texas and California, Arizona, than they are going to places like Dubai. And Portugal for a long time had a golden visa, but most people don't speak Portuguese.
Right.
But
having visited there, as long as you have a credit card, you're good. So everybody speaks Amex, right? But we are seeing jurisdictions. Portugal's was very successful. That created some internal challenges. So they've changed their program, but places like Greece have them, Spain have them. There's lots of these around the world. And my point is that as other countries are competing for that capital, people may take advantage of it, right? So I think back to what you talked about the Canadian tax authorities, and if they want to squeeze too hard, the goose can go.
Absolutely. I remember learning that parable when I was 5 years old. Killing the goose that laid the golden egg, and somehow it seems like this government never got that message.
I joke that sometimes they don't read textbooks. You tell them you don't even read nursery rhymes now? What? Gee whiz. Well, gentlemen, look, I appreciate your time. I asked you for half an hour. You were generous. You gave me a little bit more than that. And I would also encourage anyone listening, if you're thinking about any of these issues for yourself, please do not play the home game. This is such a complicated area that is so easy to make a mistake in. And those mistakes are incredibly expensive, because if you learn about them while you're crossing the border, it's really watch border security and then amp that up a little bit.
Actually, there's one more thing I want to add in that we didn't talk about that I think is hugely important. If you're thinking of moving somewhere, make sure you have the legal ability to move there before you actually do.
Very good point. Yeah, because you just can't show up in Florida and say, I want to stay. That's a whole other conversation. You're right about where can you go and what is the process for going. So thank you, Kevyn, for volunteering for another podcast. I really appreciate that. So we can maybe that be another conversation around how can you go. That's one. We can maybe have an immigration person join us to talk about that more specifically. I also think you guys have touched on something else, which we talk about in our practice, which is, so I married an American. And there's a lot of Canadians that don't maybe realize that I may have married for love, but I also married a tax regime and what comes with that. And especially things like if you're going to sell your home, it may wind up being a much more expensive exercise than you thought if you didn't plan carefully. So there's lots of ways that particular entanglement can wrap you up. So I've got a few ideas, because I think you guys have got so much talent, so much experience, and I think it can really benefit a lot of people that are finding themselves tangled up in the border stuff. So thank you for your time, and I look forward to chatting with you guys again, and continued success on your high horsepower adventure.
Thank you so much for having us.
Thanks for having us.
This has been Two-Way Traffic with Darren Coleman of Portage Cross-Border Wealth Management. Thanks for watching and listening. If you have any questions or comments or ideas for new episodes, send us an email at twowaypodcast@gmail.com. And you can find the Two-Way Traffic podcast on Facebook and Twitter. This series is a production of the Acme Podcasting Company.
On behalf of the Two-Way Traffic Podcast and Portage Wealth of Raymond James, thank you for listening to this conversation. This podcast has been prepared by and express the opinions of Darren Coleman and his guests, and are not necessarily the opinions of Raymond James Ltd. Statistics, data, and other information presented are from sources Raymond James believes to be reliable, but their accuracy cannot be guaranteed. This podcast is for information purposes only and is not construed as an offer or solicitation for the sale or purchase of securities. Investors considering any investment should consult with their investment advisor to ensure that it is suitable for the investor's circumstances and risk tolerance before making any investment decision. Past performance is no guarantee of future results. Information provided in this podcast is general in nature and should not be construed as providing legal, accounting, and/or tax advice. Should viewers have any specific questions or issues in these areas, please consult your legal, tax, and/or accounting advisor. Raymond James Ltd. is a member of the Canadian Investment Protection Fund. Raymond James USA Ltd. is a member of FINRA and SIPC. Raymond James Ltd. and Raymond James USA Ltd. financial advisors may only transact businesses in provinces and/or states where they're registered.